This is the third video of a 5-part series that I've been making. I made a video some time back on how to build wealth and achieve financial freedom, in which I gave 5 tips about how to do that. Now, I've made videos on the first 2 already, and this is the third one in which we're going to talk about investing and investing for the long term. Now, you must have heard this or read about this somewhere where people say that, hey, if you invest like 500 rupees every month, in 40 years, you will become a crorepati. Now, mathematically that is true, all right? If you do that for over 40 years, you will get to a crore. But then, who's to say what the economy will look like in 40 years? And what will that 1 crore be worth? Now, if I can get that 1 crore in the next few years, maybe 5 or 10 years, that makes a lot of sense. But 40 years? That's too long. And it's not practical for us to keep this up for over a period of 40 years. Now, some people do that, but not most of us. So, like I say in that video, that investing has a lot of benefits, but making you rich is not one of them. So, it will help you maintain a certain lifestyle. It will make sure that you have this corpus that you can fall back on and make sure that you have this confidence of doing things that you would like start a new business, change your profession, because you have something in the background as an emergency fund or as a retirement fund stashed away. So it gives you that confidence, that's true, but it will not make you rich per se. All right, so let's talk about investing. Now I'm going to talk about 4 things that you can invest in. And obviously there are more than 4, and if you know these, then obviously go ahead and invest in those. But I'm going to talk about the 4 most common ones. And that is, firstly, the stocks or stock market, mutual funds, debt funds, and gold. And the order in which I've said this also denotes how risky they are, which means that the stocks are the riskiest of them all. Mutual funds, slightly less, debt funds, even lesser, and gold is the least riskiest of all of them. So now you would typically find people saying, hey, you can start investing based on your risk profile and your risk appetite. But what is risk appetite? At the start, maybe you and I don't understand what a risk appetite really means. Like, what is my risk appetite? And so if you don't worry about it. We're a little far away from getting really expert at it, so it's okay not to understand what is your risk appetite for now. But many of them will tell you, because you're starting off, start investing safely or in safe instruments where the risk is not much. Right? You need to invest in things that you know will give you sure returns, albeit lesser, but sure nevertheless, so that you don't lose any money. But I'm going to tell you the opposite of that. I'm going to tell you, start investing aggressively in the beginning. And the reason I say this are twofold. One is, in the beginning, you're just starting off, which means that you don't have a lot to lose yet in terms of money. Probably you have very little or maybe nothing if you're just starting off now, not much to lose. And so if you have to make mistakes, I would say this is the right time to make mistakes and learn from them. Instead of waiting till you build a corpus and then start to make some mistakes and learn from them, because if you make mistakes with a big corpus, you obviously stand to lose much more than what you would do in the beginning. So that's reason number 1 on why you should start aggressively. And the second reason I would say is that we're not in for 40 years. If you actually go back to the series that we're making, we're giving ourselves a target of 10 years, in some cases 15 years. And so we're not going to sit here on some money that's going to grow very slowly. We want to be a little aggressive so that we hit that goal sooner than later and become financially independent. So I would say start aggressive. All right, so I'm going to talk about stock market investing, obviously, because that's the riskiest, and I'm saying start aggressive. There are other things, like I said, mutual funds, debt funds, and gold, and we're not going to cover those in today's video. We're just going to concentrate on stocks. So what is stock or stock market investing? How is it different from mutual funds that we commonly hear. So pretty straightforward, guys. Stock market is you're actually buying stocks directly of the company, whereas in mutual funds, you're giving your money to a mutual fund manager who on your behalf will buy the stocks. So he or she gets to decide which company stocks are they going to buy. But in stock market investing, you get to decide which company stocks are you going to buy. So that's the main difference. Now, how do you get started? Because let's assume that we're not so analytically sound, we don't understand the stock market, we don't understand what these numbers mean, and so how do you start? Now, this is how I began, and I would recommend that you start with this too. Is obviously over time you will build your knowledge in stock market investing, but until then, for you to get started, this is a good way. In fact, even at an advanced level, this is still a good way to follow. So first off, because stock marketing is buying company stocks or brands, we know these companies around us. So as an exercise, sit down and think of your favorite brands, things that you use on a daily basis, maybe some services that you use or some product that you use on a regular basis. Think of these companies and list them down. List your favorite ones. We're not looking at who's the most profitable, who has made the most revenue, none of that for now. Just look at your favorite ones, the ones that you use on a regular basis and are closely connected with, at least connected with their service or product. I can give you examples. If you talk about Google as a company, we use Google every day. The search engine, YouTube. We could talk about Apple. We love Apple and the iPhones that they have, or the MacBook or the iPad, and companies like these, right? So list down 20 of your favorite companies. Obviously, on the top of that list will be companies that you use very often, and then as you go further down that list, maybe their products you wouldn't be using as often, but these are your favorite companies. Now, because they're your favorite, obviously that it means that you've been using them for a long time. It means that they've been in the market for a long time, and it also means then that they will probably last in the market for a little longer. So it's a safe way to look at it that way, that you're picking up your favorite stock. Obviously, if you're picking up a company, your favorite brand, just based off of an experience you had in the last 2 months, they wouldn't be your favorite brand unless they've really gone above and beyond. But in most cases, it will be the ones that we use on a regular basis and have probably grown up using. Okay, once you've listed these 20 companies down, I want you to listen to something very interesting that Warren Buffett says. Warren Buffett says that usually when the stock markets go down, that's when people are panicking and running away from the stock market. They're selling all of their stocks. They avoid buying anything because it looks like everything is going under losses, and they run away from it. And he says that's surprising because if you actually compare this to, let's say, a shop in a mall, and they're selling something on discount, right? Which means that you see a 30, 40, 50% discount board right up in the front of the shop. Now that shop will be overcrowded because people want to buy that stuff at that lower price. And he says it's surprising why people don't think of stocks that way. So stock market going down means that these stocks, some of these good stocks, your favorite companies like the Apple, the Google, are actually available at a discount. Their stocks are slightly underpriced or undervalued because of the stock market condition. And now, or this is a good time to buy. We have been in a sort of a recession or a down market since the beginning of this year, 2023. It looks like it will continue into most of 2024 as well. This is a good time because a lot of these stocks are underpriced or undervalued. And so if that's the case, Warren Buffett says that that's a good time to actually buy and then hold for a long time. So keeping this in mind, and now that you've chosen your 20 companies, just go and look at these stock prices on Google and find out how their stock prices have behaved over the last maybe a year or 5 years. Understand if these are behaving as per the average price. Typically you don't have to be very analytical about it. Just look at how the price has behaved over the last few months, and if you're seeing that they are slightly on the upward trend, that means that they're going up. May not be the right time to buy them right now. But if there are stocks that are fluctuating a lot and are on the down, slightly below the average that you find over there, maybe that's a good time to buy. These are your favorite companies, so you've already established that these are safe companies to invest in. And so if the stock prices are slightly undervalued, this is a good time to buy. So if you have, based on the previous video that we talked about where we set aside some budget for investing, if you've got, let's say, 6,000 rupees to start investing on a monthly basis, look at these 20 companies, you maybe shortlist them once. Say 15 of them are actually showing an upward trend, and maybe there are just 5 that are slightly below what you think must be the average. And invest your 6,000 rupees in those 5 companies. Important thing is, you need to keep it there. We're not trying to time it by putting it at a time, putting your money in at a time when they are slightly underpriced, so that you wait for the next few days, and when it goes up, you're trying to sell it. That's not the idea. That's trading. That's totally different. We're looking for investing for the long term, which means when we see that it's slightly underpriced, we buy and we hold. The next month, when we get the next 6,000 rupees to invest, we do this exercise again, see which are those companies that we want to invest in. Maybe this time around, the 5 have gone up. Maybe some other companies are slightly below the average. Now, remember, there is no actual average. This is just what you feel should be the average. And may not be 5 companies all the time. You probably might find 10 at times. You might find just 2 or maybe just 1. Just decide which one you think is behaving in that way that you'd like it to, and invest your money in that, instead of giving your money to a mutual fund manager. Now, once you've invested, like I said, minimum a few years. We're not thinking about days, weeks, or even months. We're talking about a few years until you start to see that money grow. In one of the earlier videos where we talked about setting goal, well, that's the first step, we talked about that we wanted to have 2.2 crores because that's the kind of house and cars that we'd like to buy. So we want to have a corpus of 2.2 crores. So that's our goal in the example that we're looking at in the series. Now, your goal could be different. It could be higher, it could be lower. It's totally dependent on you. But whatever is your goal, my recommendation is that until you hit 50% of that, you keep your money in the stock market, in stocks specifically, and try to get to 50%. So in this case, if 2.2 crores is your goal, maybe you want to wait until you hit 1 crore in stocks. And once you hit that, then you move from stocks into safer instruments like the mutual funds we talked about, or the debt funds, or even gold for that matter. And then whatever new money you're getting in, you keep investing in the stocks. It's riskier, but the gains will also be better. And once you've built a corpus, you don't keep all of that there and continue with that risk with a bigger amount. You just move that into a safer instrument, knowing that it will earn interest, probably lesser, maybe a lot lesser than what you have earned in the stock market, but at least you know that it's safer there, because now you've got much more to lose. You don't want to mess up with a bigger corpus that you've built up over time. So here's just a simple blueprint of how you can get started in investing, and what are the things that you can look at, learn. Over a period of time, you will get better and better and become maybe an expert in doing this. But to start off with, this should help you start your investing journey and start aggressively to make sure that you're building a corpus quickly and trying to get to your goal faster. So I make videos on personal finance and personal growth. So if you like this kind of content, please like and please subscribe. And as I always keep saying, race only against yourself because then you will always win. See you in the next video.